Good morning, ladies and gentlemen. Well, all last week I told you to keep on watching the dollar because the dollar and the walkback or potential walkback of the tariffs is the prime market mover at the moment as opposed to interest rate differentials. I was right in being very weary up here, and now we could easily be getting an ABC kind of retracement as people doubt that the tariffs that will be imposed will be as large as speculated. So DXY is retracing. Where are potential levels for DXY to go to? Well, the first level that I can see is around 106.30 down to 106.10. That seems to be the prime level that one can get. I very much doubt that the market could go much lower before we have clarity from the White House about the proposed tariffs, and I don't think that the tariffs are going to go away. Therefore, that kind of level makes a lot of sense to me. If we have a look at Euro USD, that kind of level is here. We're talking about 105.75 up to 106.10. So those are the levels that I have in mind to start selling the Euro USD and buying the Dixie. If we actually have a look at the Euro index, it's broken above the very important 104.60 level, and having closed the week there, I think it has a decent shot of getting up to 106.30. So throughout next week we'll be triangulating these three charts and looking for matches up here to then do some option strategies, because I think some option strategies like straddles here are going to be very profitable in the long term. Long term straddles struck around here I think are going to be the thing to do, because at the moment volatility is relatively cheap, but I don't think it will stay there under Trump. I think that we will at some stage go all the way below parity, because I don't think that the interest rate differentials can narrow enough to sustain a euro going up above 107 or something like that. So that is my thinking at the moment. We're having a period of retracement on the back of not knowing what the tariffs are. We went too far. We are retracing and getting a second bite of the cherry, because I think the tariffs will come, and that will be something to look for next week. And if you look at the differentials, you can see now this is twos. You can see that supporting this retracement in the dollar. The differentials are coming in. It would be lovely to see twos on top of the 200-day moving average at 185. I think that is definitely where you would want to buy it. Fives, they're closing on the lows, which to me makes sense that they will break down towards 195, and tens, I think they're definitely going to go down to 203. What does that mean? Because next week we have the FOMC and also the ECB the day after. The ECB is projected to cut, while the FOMC is not projected to cut. So you are most likely going to get a repeat of what Wallace said from the FOMC, which is basically that they still think that rates are restrictive, and also you are going to get the data dependent story. So they're going to say we think the rates are restrictive, but we will only cut when the data allow us to do so. The market is then going to start pricing in a higher probability of cuts in the US, And at the moment, we have something like a 25-28% probability of cuts in March. And I reckon they're probably going to take that probability up to 50%, maybe even 60%. While you already have the best part of 4 cuts priced in to the euro, and my guess is that the market in the euros does very little, if anything at all. So let's have a look at those individual yield curves. Here you have the Schatz. The Schatz has a lot priced in, and I think it can easily go to this kind of level, to 38 to 40, where you definitely want to be a buyer of it. I don't think that the differentials can go very much further. So what am I saying? The Schatz goes up a little bit and then starts coming down, but it comes down with twos, and that differential maybe doesn't move very much. In the 5s, to me, the level is somewhere around here, 240. And the 10s, I think, are going to struggle to go much higher than 257 to 260. And I think you want to be a buyer of those at that level as well. If we then have a look at what the US is likely to do, well, if they start pricing in the cuts into March with a higher probability, you're probably looking not very much, but you're looking at 412, 414, so the 2s aren't going to go very far. The 5s could go a little bit further, say 427 to 420. The 10s probably less, 450-ish, and then a period of stability around 450, while the 30s 471 and then nothing. So you're getting to a period where, yes, the yield curve should steepen, but it should really steepen in the 5s, 30s. So 2s, 5s, let's have a look. I don't think the 2s, 5s do very much. In fact, the 2s, 5s could even push up. But it should be the 5s, 30s in my mind where most of the action takes place. I don't think that the 5s, 30s can go much higher than they are. I think they are more likely to come down towards this 52 level over the course of next week or maybe the week after, because don't forget we have an auction of 2s and 5s on Monday and 7s on Tuesday. Once that is out of the way, I think that you will see a movement in the 5s more than in anything else. 2s, as I said, I just don't see them going very far. 5s have got positive carry, and with the 5s trading at 442, they could go down to this kind of level, 227. I really don't see them much more than that. So I see a period of stability in the yield curve in the US, i.e. not very much movement to the downside, but I think more movement will come to the downside in Germany once this move back to, and let's have a look at that again, once these moves have exhausted. And I think anywhere around 185, 190, 2s will have exhausted themselves, and then you can start looking for the Schatz to start appreciating more than the 2-year. And that should set a top for the dollar. So once the 2s are down here, I think the dollar will be exhausted and it'll be ready to turn. Just one last look at the 5s, because it's interesting, as you will have an auction on Monday. I think if they push it back to 450 and try and get it off at 450, it's a decent risk reward to actually buy it. And something like the at the moneys against something like this yield of 430. On Wednesday, I'm pretty convinced that they're going to take the probabilities of cuts in March slightly higher. And that is because I think that Powell will not miss the opportunity to tell us that the new rent index is going negative. Don't forget that he talked about the new rents and hoping that they would lead the inflation picture lower over time. And now that he's getting the new rents at negative, I don't think he will miss that opportunity to tell us, I told you so. And that should get the market juiced up for a few, hours, days. So I think the FIs are the ideal instrument. If you see them on Monday having backed up a little bit to around 450, I would buy them. An option at the money against 3/4 of a point out of the money. That to me would be ideal for 1 week, because I think Wednesday and Thursday we get down to 426. That would be my bet. Overall, I still see absolutely no reason why the yield curve shouldn't continue steepening from levels. This is 530s and my favorite. I think we will stabilize in the yield curve around these levels, -67 to -52. That is where I think we will trade for a long time. Again, as I mentioned, I think Powell will be dovish because he'll mention new rents, and the market is going to take it dovishly, and the front end will do better than the long end. Until the QRA comes out and we get some Besant news. And don't forget that Besant will come out and will do something, because his 3 arrows, i.e. the 3% that he wants to see real growth, and the cuts in the budget deficit, only can happen if he takes actions. So there will be news from Besant at some stage. Until that happens, I think the yield curve keeps on steepening. He will want to flatten it at some stage, but probably not for a long time. To me, steepening is the natural thing for the yield curve to do, all the way into QRA, and then we see. GSG, i.e. commodities, was interesting last week. Oil came off and we couldn't sustain the break out of the range. That is likely to bring down GSG over the next few sessions, certainly down to this 2240 level, and then we kind of see. But I think that Trump was very clear that he wants to do a deal with OPEC and the Saudis to get oil lower, and therefore that would eventually lower inflation, and therefore we can have interest rate cuts throughout the world. What is interesting is GLD over GSG. I told you a couple of weeks ago to prefer gold because we're getting to support. GLD over GSG, I think, is going to go higher from here. This is the 200-day moving average. Every time it gets there, it bounces. And I think that this is one of those moments, and let's go further back in time. I think over time we can get up to here, so prefer gold to commodities still. This kind of level, once broken 12, we could have quite an acceleration in this move. Gold is definitely a better bet at the moment than other commodities. And if we look at gold, given that the probabilities are that Powell is dovish, or that the market interprets him as dovish, and also that the dollar has got a little bit more to give up, it's not surprising really that gold is bid. If we have a look at what it's doing on the weeklies, I would not be surprised to see a spike through the 2800 Bollinger Band, getting everybody long up there. It's a quick trade for me. but I don't see how gold can come off substantially. If you were to buy some cool spreads in gold over the, on Monday for the week, I just don't see how you're going to lose a whole load of money. It's not something that is likely to come off very much, given what everything else is doing. And, as I showed you against GSG, it's still very much bullish and something that you should be buying. And if bonds are going to be doing okay next week and the threat of tariffs still weakens the dollar by another % or so, although I want to go against it at the levels that I showed you, means that for the first few days of next week, gold is really not going to be offered. It loves spiking the Bollinger Bands on the weeklies, so that's what I expect. They're at 2,800. I'd expect it to break that, and then we see. I am not a huge buyer of gold up here, but I am for a trade. There's a difference between a trade and positioning, and I can't trade it short because I don't see any reason to trade it short at the moment. In terms of risk indicators, and this is ITOT over government, we still continue to make new highs. SPY TLT, the same story. SPY over IEF, the same story. SPY over SHY, the same story, slightly less. But I think probably we're due a pause. I would not be surprised to see the market come back because we have all those earnings from the big tech companies as soon as Powell sits down. So Powell will sit down at 3:30, at 4:15, we get the three big ones. I think Amazon is probably the least of our problems, but the others could be problematic, or the reaction of the market to them could be problematic. There are some signs that not everything is fantastic in tech land, and let's have a look at a few tech charts and spreads. We've had the earnings for XLF, i.e. the banks, and they were excellent. We are about to get the tech earnings, and that's XLK, and this chart is looking very sick. This chart should not be looking like this. I think that we have an excellent opportunity to go down and break these levels where we were in November. It's not really a very great chart because we are at the same level in XLK over XLF where we were in 2020, or mid of 2020. And that really is not where we should be, because everybody's been telling you how this is the most wonderful stock market, which is being led by the most fantastic tech companies in the world. And have a look at, this is JPM versus Apple. So I'm a bit worried here. I think that we might get some surprises, because this doesn't make any sense. This chart should be looking completely different if everything is fantastic in techland. It might be, but this chart does not say so. So I'm a bit worried about XLK, and if those tech earnings slightly disappoint, or the guidance disappoints, or the investment disappoint, I think you could get quite a big move in XLK. And I think you could get easily a move back down to 224, which probably will be enough, but that will be enough to hit the SPX for 6, or certainly the NASDAQ more than the SPX. So it takes it back to the levels that we had a couple of weeks ago, and actually to the levels that we had in November. So let's have a look at that. So here we have NQ. And unlike SPX, it didn't make a new high last week. And it's looking a bit toppy, isn't it? It's looking like it can't go up very much. The Bollinger Bands have turned inwards on the weeklies, showing consolidation. And I really wouldn't be surprised by a retest of this 20,400 level. You know, it's a big move. It's 1,300 points, but in the greater scheme of things, it's not very much at all. So why not? The real support, the first real support here is at 20,600. What would it mean? It just means that we fill all these gaps and we go back to the 200-day moving average. What does it mean on ES? Well, it means a lot less, but here also you're getting the resistance of the Bollinger Bands, of the weekly Bollinger Bands, and all it means really is that you go and retest something like 5,900. It's not such a ridiculous thing to expect. First support is here at 6,003, and then all we're saying is that, wow, this could fill the gap all the way down to, 58.65. How ridiculous is that? Well, I don't think it's very ridiculous at all. There are better sectors than XLK, as I showed you, and those are XLF, XLI. Those are the ones that seems to be doing best. At the moment, I think all the danger is that as soon as Powell sits down and probably NQ is bid to old boots because bonds are bid, you get a cold shower. So there we are, a degenerate trade for you. Buy call spreads on Monday on the 5-year and the 2-year, and then as soon as Powell sits down, buy put spreads on the NQ. So those are my best ideas for next week. I've kept it short and sweet simply because I think so much is going to depend on the nuances of what Powell says. My bet, and I think it's a very good risk-reward bet, is that A, he mentions the rents, the new rents, and that the market takes it very bullishly for the short end of the bonds. That steepens the curve. And then we see the real interesting trade, which will be what happens when the tech earnings come out. And I think those will disappoint. I think those will disappoint because the market knows something, because XLK over XLF should not be looking the way it does. We all know that the banks are going to be fine because of deregulation and the fact that the economy is going to stay strong. There are absolutely no signs that the economy is going to weaken out of sight and that the banks might be in trouble because of loans, defaults, etc. So I think XLF, as a sector, you keep on buying the dip. But XLK is a different matter, and since those companies are so big in the indices, you could get a real surprise. Nobody is long puts on the indices, and I think that they might regret it. Again, these are, trades as opposed to positioning, and we will do them and monitor them in real time next week. But I really think that we could be close to a very interesting turn in the indices. Thanks very much, and I will tweet you tomorrow.